Welcome to episode 28 of Contrarian Corner. My name is Ben Kellerin. Today we have a couple very special guests. We're going to be talking about Calumet, so I'll get the cover your ass disclaimer out of the way right at the start. We all have positions in the stock. We'll be talking about it, and we're all biased for that reason. So do your own research. If you want to start with this, great. If not, it's your money, your responsibility. Do with it what you will. So with that, I have one guest, Raging Bull Cap, also known as Jake LaMotta on Twitter, or Dylan. But he's got a very interesting Substack. You guys should definitely go check it out. I'll put a link in the description. And we also have Karst Research. He's staying anonymous, but very entertaining guy, very funny on Twitter, and also has some interesting stuff to say on different investments, different things in the insurance industry as well. So with that, I think we'll get into Calumet, kind of start talking on, I guess, the 30,000 foot view before we really get into some of the recent events, because I think it's a good place to start for anyone who's not all that familiar with the company. So Dylan, if you want to lead off with kind of the basics on Calumet before we get into like the DoE loan and all that stuff, I think that'd be a good place to start.
Yeah, 100%. So, it's kind of talking about it before we start recording here, but, it's very popular and polarizing name in the value investing community. It kind of has a lot of dynamics that I think as investors we're, innately attracted to, right? You've got a big sum of the parts discount story. You have multiple event-driven dynamics. You have, a strategic, unique asset with, purportedly some pretty good competitive advantages. You have very levered equity, right? So there's all these things that have drawn people into the name. And so just kind of backing up a little bit and just, what the company is, right? It's somewhat of a long story, but essentially they've got a legacy business, refining assets. And, from those refining assets, they have a specialties business, which does, specialty chemicals, lubricants, stuff of that nature. And, basically it was packaged in an MLP structure, a master limited partnership. For anyone that doesn't know, it's, somewhat think of it as a REIT, right? Like you're incentivized to pay out distributions. And usually, companies under this wrapper have pretty steady and stable cash flows, obviously because you're limited in your ability to reinvest. And, at some point in the mid 2010s, these guys went on a buying spree, acquired a bunch of assets, levered up to do so, and then ran into a bit of trouble, had to cut the dividend, I think in like 2016, which kind of busted the MLP structure. And, by happenstance, they had purchased this refining asset in Montana, the Great Falls refinery. And, it just, by happenstance is, the perfect asset for a renewable fuels facility, due to proximity to feedstocks and proximity to, the most likely end markets like California and the Pacific Northwest and parts of Canada. And so for the last, I guess, 3-4 years, the company's been in the process of, expanding that refining asset into a renewables facility. Started with renewable diesel, and now they're trying to build up to SAF, or sustainable aviation fuel. And, in that backdrop, there's tons going on, which we can unfold, right? But, there's this event-driven path, which has kind of been a 3-part trajectory, which is one, converting the MLP into a C Corp, which did happen at the middle of the year. 2, securing financing from the Department of Energy, which is necessary, both to expand the capacity in Montana, but also to delever this like really hairy balance sheet. And then the third part of it, which we're still kind of, well, I would say we're kind of one and a half way through these 3, right? Like the loan's been announced and we'll get into it, but hasn't actually closed. And then the third step would be some kind of monetization or partial monetization of Montana renewables, which would then obviously help to further delever the parent. And so that remains to be seen how that unfolds, but that's kind of the high level thing. And few other factors moving there is a nascent industry with RD and SAF, and a really kind of complicated backdrop with their government subsidies, weak margins right now, and then on top of that, the company's been burning cash for a long time, right? So you've got all these things kind of going on, and I guess, I mean, maybe give it to Karst from there, but that's sort of, that's the high level of what's happening here. And then, I think each of the three catalysts are worth kind of unpacking a little more as we go through.
Yeah, I think that was a good overview, and then we can get into some of the DOE loan stuff, because the way I was kind of looking at it when I first wrote about it, I think either February or March, was like, okay, C Corp conversion, loan, like go through the list. I was like, when all this stuff happens, like at least those first two, I was like, yeah, we're probably looking at like 25, 30, maybe some more depending on what happens, but it's still sitting in the low 20s. And I thought that's pretty interesting. But I know Karst has been blowing me up about the reduction in interest expense and some of the other things around the DOE loan. So if you want to kind of get into some of the structure there on the DOE loan, I think that'd be a logical next step.
Yeah, I think when I kind of think about like the importance of the DOE loan, obviously delevering the balance sheet is important, but on the, like when you cross the bridge and you have these funds, you have to keep in mind, like the goal is obviously to expand the SAF capacity at MRL. And there are two kind of phases to that project. There's, max SAF 150, which is getting them to, 150 million gallons a year. But on the backside of that, you have to think about the demand side of SAF. So, in some of the presentations that Calumet's put out, you have, the EU's 2% mandate for, SAF targets at, by 2025, 6% by 2030, and 70% by 2050. So there's kind of a structural tailwind from like a regulatory perspective for the product that they're actually going to be putting out, right? And so when you look at the DOE loan, you have to look at, I think, how they're currently structured from a, the capital structure and the balance sheet versus what it's going to look like on the back end. So when you kind of think about, $2 billion of debt currently, 1.6 billion of that is recourse. They have interest rates right now ranging from, call it 8 and an eighth to 11%. That's a fairly sizable interest rate, and this DOE loan of size of 1.44 billion is at Treasury and a 3/8, right? So 4.38% right now, which is a pretty favorable reduction in actual financing. So when you kind of think about that, there's like a total drop in interest expense, which is around like $79 million a year. So just from a leverage perspective, the DOE loan is pretty favorable to the operating income. Well, not the operating income, but from a total usage of capital that they can use to actually fund the max SAF expansion, that max SAF 150 project.
Yeah, do you think the way I think it's kind of interesting too is like it doesn't seem like they've gotten much credit for like the deleveraging. Do you think that the cash actually has to show up like the final completion to like get the stock price to react a little bit? Or do you think there's just kind of an aspect of it is that like the stock's already a hedge fund hotel, like it's already kind of priced in, like there's not much juice even when the money shows up?
So I think when I think of the DOE loan, I do think of it in like two steps because it comes in two tranches, right? So the first tranche is, 778 million, and then the second tranche is the remainder and of 1.44 billion. So what they're going to do in essence is part of the second tranche that they receive is going to be used towards actually expanding their max SAF project. So I think part of the maybe reticence that investors have or what's kind of overhanging the stock prices, it does come in two stages, and there is a equity requirement for actually using and drawing on the DOE loan. It's 45% equity, 55% loan. So what they're trying to do in essence is de-lever the balance sheet on the front end so that they can then draw on the second tranche to use to expand that max SAF 150 project. So they're going to have to do a capex investment of 150 to 250 million dollars to actually expand out MRL's SAF capacity. So part of me thinks that once you have the initial tranche of the loan come in, you're going to be able to see incremental gains in the stock price, just because they can actually start executing on that, because there is that contingency towards they're going to have to put up cash and as an investment to expand that capacity. It's going to be 65 to 115 million bucks that they're going to fund via retained earnings. So I think there's the fact that it comes in two tranches makes it a little bit, I guess, opaque to investors, because obviously you see, till $2 billion of debt, $1.4 billion is going to be coming in. They're going to delever the balance sheet. It's going to be a better interest rate. Obviously, that's amazing. But you do actually have to execute on the business plan. And I think that goes to what we were talking about further. Earlier before we kind of started recording was, management's been able to basically hit each target that they've set out to do, whether it's converting the MLP structure to a C Corp, whether it's the CEO being aligned with shareholders, whether it's the dilution aspect of the actual MLP conversion being favorable to shareholders. They haven't overpromised by any means on these like big goals that they've set out to do. So I think, it's a proof is in the pudding story. And I do believe that once you have that first tranche come in, it's probably positive because they can start affecting the actual plan that they've put in place.
Yeah, I guess to play devil's advocate here on some of the political questions around Trump and the Department of Energy and the loan program there. I know there's been questions getting thrown around on Twitter of like, what happens if the loan isn't closed before Trump comes in? What happens to like the second tranche that is set up to be basically dispersed from 2025 onwards? Is there any opinions you guys have on any potential political impacts? I don't think there's, I'm kind of leading the witness here, but I don't think there's going to be like a huge political impact depending on what goes on at the DOE and who kind of gets put in charge.
Yeah, so I think there's kind of a few different ways that the market might be looking at it, and we can kind of think about which one of those is most plausible, right? But there's one notion that the stock failed to re-rate on the announcement of the loan as anticipated, due to some apprehension about whether this actually closes given the change of administration. And so there is a piece of this in the press release kind of saying the first tranche is going to close by the end of the year. I think there is some skepticism about that, but let's just assume it does, right? Then I guess I think if it does close end of year, you've probably taken a lot of that risk off the table, because I think once you close on the first tranche, it's going to be pretty difficult for someone to come in and fail to execute on tranche two. But I sort of think even if it doesn't, the incentives aren't really there for the Trump administration to revoke this, right? Because despite maybe some optics being averse to clean energy movement and whatnot, this investment in Montana, there's a lot of other stakeholders involved here. The agricultural industry, a lot of people who are sort of part of that key Corn Belt Republican constituency, right? And so I just don't think the incentives are even there for the Trump admin to revoke this conditional loan. So that's kind of one piece of it. And then the second is maybe what happened with respect to the market not re-rating the stock after the announcement is that this is just what the market thinks the fair valuation of the company is, notwithstanding the loan, right? There's one argument, which is to say that the market was already almost entirely pricing in this loan hitting. And now the question becomes is the path forward viable? Is the SAF industry going to be economic moving forward? There's these kind of questions down the road, which Karst kind of talked about with respect to the second tranche, right? Which is actually building out the expansion, and then at the end of the day having unit economics that make sense in an industry that is completely novel. So I think there's that's definitely, I think, some of this, right? It's just a confusing and uncertain future that's not necessarily resolved from the loan. But the way I sort of see it is, you do have this just accretive deleveraging that Karst talked about, but you also have, a de-risking in the near term, because you had some pretty big maturity walls coming up here. They've refied the 2025s, probably take out the 26s. And so what's happened now, regardless about how you feel about valuation or if you thought the loan was going to close, I think holding this equity has become, increasingly de-risked over the next like 12 to 24 months. Whereas if you didn't have this, you're probably looking at some need to monetize parts of the legacy business, like the performance brand segment, for example, just to keep the liquidity sufficient to go forward. So, my view is, well, first of all, I think it's worth a lot more than 20 per share, and we can get into that. But, my expectation of the market being excited about this loan was just like, hey, like this is not as risky to hold right now, right? So either there's like some big apprehension about the politics going on here, or this loan was fully baked into the price before it was announced, which I find really hard to believe, given that the consensus with respect to the size of the loan was quite a bit under the 1.44 that we got. So that's my take. And then obviously there's some technical dynamics that might be at play here, although I think as time unfolds and the stock stays at 20, those arguments become less and less plausible, right?
Yeah, I think one of the things that's interesting there is, like you said, with Trump getting in, I think it is unlikely, because I mean, just to be perfectly honest, he's got bigger fish to fry than worrying about what essentially is chump change to the government in like a loan program like this. So it'll be interesting to see, but I doubt, like you said, this comes back to they have some clawback or something like that. But I don't know if you have any thoughts on that topic at all, Karst.
I think I don't think that there's much. I mean, obviously, you never know what a politician's going to do. I think I do believe that the loan will close in late part of 2024. So probably December, about like late December. I don't think there's any risk that Trump comes in and pulls this. I think there is, there was a great chart that I saw, which was a big chunk of the offtake agreements that are actually being proposed for SAF is a function of regulatory government mandates, right? So I think the more mandates there are globally, the more incentive there is for the U.S. to be a part of this type of market. And I think the reason the loan was provided, the loan program office at the DOE is to be able to, enhance like American energy companies. So I do believe that the loan closes. I don't think that there's, political risk here in the same way that, there might be in other industries. I think this is probably here to stay. And I think when the first tranche closes, as, Dylan said, the second tranche will be pretty much baked in.
Yeah, interesting. The one of the things that sort of come up before we start recording, but also in kind of the first 20 minutes of our conversation here, is like the just viability of SAF in general. And I guess if I'm playing devil's advocate here, I'd love to hear you guys' thoughts on this. But like what I wonder is, how viable is this as a long-term industry? Like, I think you said like 70% for Europe will be, or at least that's their goal, is their target is 70% of aviation fuel by 2050 will be SAF.
Yeah.
And I think that's probably pie in the sky. I'm not saying it's impossible, but I have a hard time believing it's actually like 2/3 or more. So I'd be curious to hear you guys' thoughts on how economically viable sustainable aviation fuel is long term without subsidies or without some of the government assistance.
Yeah, good question. So my personal thoughts are a couple of things. I think there's a lot of I think traditional fossil fuels are going to be here to play a role in our economies for a very long time, longer than the typical green movement would like you to would like, frankly. However, I do think that no matter what, there is going to be a pretty meaningful trend towards towards renewable fuels, whether it's renewable diesel or whether it's, sustainable air fuel. So I think even if, you're an individual that's hyper pro fossil fuels and you hate the green, the green industry of wind and solar and whatnot, I do think it's kind of, you're right. I don't believe 70% of all, the refuel EU targets are going to be, by 2050, SAF. But I do think that it's going to be a fairly significant portion compared to what it is today. And so if you do believe that, then I think, the industry as a whole is going to, expand fairly, fairly, fairly largely, but it's a matter of the degree to which, right? I think at 70% by 2050 in the EU is probably a little bit of a stretch, but I think even if you get to, 10% or 15 or 20%, that's a material increase compared to what we have today.
Yeah. What do you think, Dylan?
Yeah, well, I'd echo a lot of that, and I think in the U.S. context, right? I think the sort of the goal is. I was just reading a report that I think the DOE published last week, right, which is helpful to review for anyone interested in the idea, right? But I think by 2050, their goal is to have 35 billion gallons produced per year in the U.S., right? And right now, I think this year's run rate is like 16 mil or something, right? So a long ways away from that goal. And then, with respect to the economics, airlines, I think the cost of this is like 2 to 10 times, fossil jet fuel, right? And these companies already run on razor thin margins. And as anyone who travels knows, the price of a normal domestic flight is just getting outrageous, right? So the options moving forward, I think, at least in a transition to sort of get to where we want to go with this, you need government assistance. Like the economics just don't work at the moment, right? So the question sort of becomes, how do we bridge the gap maybe to getting this economical? One of the things that does help a little bit is just having scale at these production facilities, and it helps a little bit with the cost, but doesn't take you anywhere near where you need to get. So you're gonna need some kind of subsidies, and the question becomes, how do you align incentives, right? Because the way things stand for private market participants without any nudging from the government is you have the airlines who want to be able to signal that they're using clean energy, but it's not economically viable. Then you have the producers of SAF who can't turn a profit without subsidies. And then you have obviously the government who wants to sort of nudge us towards this transition. And so, do the airlines pass it on to the consumer? There's no way that's going to happen. So you're going to need to rely on a regulatory backdrop with subsidies. And, part of what is, part of the complication with this thesis, kind of going back to why maybe the stock hasn't reacted the way we expected it to, is you have a ton of uncertainty with the backdrop of subsidies, right? Like, where do these go? There's so-called stroke of pen risk that's pretty major here, because not only do you need to have kind of clarity on what's going to make this economically viable, but until you have long-term either offtake agreements or commitments that are robust and durable from the participants involved, it's too difficult to make the necessary investment to get anywhere close to those goals. And so a lot of that remains to be seen. And I think it's kind of hard to come up with a definitive answer. But I think you can live with that uncertainty here. And the reason for that is, both the valuation and kind of these event-driven dynamics, and because you do have clearly the kind of crown jewel SAF asset that exists right now in the US. And so, to the extent this does work, MRL is going to be a big player in it. So yeah, I guess my sort of the way I kind of look at this more broadly is a lot of uncertainty, but I'm not sure there's a ton of near-term risk, right? So whether this works out in the long run, honestly, it is tough to say. I think I think they'll find a way to make it work, but in the nearer term, there's kind of these more interesting event-driven dynamics and quality of the infrastructure that you get. Plus, with Calumet, obviously, right, you do get the traditional refining assets, the other segments of the business, which help, right? But that's kind of my take on it, and I wish I had more conviction one way or the other. But as Karst kind of said, when you have governments involved, you just never really know what's going to happen.
Yeah, no, I think that's a good point, because the way I kind of look at it long term is I wouldn't be surprised if kind of sustainable aviation fuel ends up in a similar bucket to solar and wind and what their like true economic viability is. But at least like you said, over the next couple of months, like that's where you have the loan, you have some other stuff going on that I think makes it interesting. But I think that'd be a good place
on
to
top of that as well. Sorry to interrupt, but you have commitments from the airlines now, right? And you wonder how much of that is just posturing and like ESG posturing, how much of that is real. And obviously there's a huge element of ESG posturing, because why would you be inclined to take on something that costs 2 to 10 times more than your ordinary input? But you do have this like coalescing around SAF as being important from all industry players. And so to that extent, I read that pretty optimistically. Whereas maybe in some of these other industries, I guess one of the things that's worth thinking about, right, is how much of this is just like some bogus public sector ESG thing where the economics don't make sense at all. I don't like ethanol. I mean, maybe ethanol makes somewhat sense, but it's like, is it like ethanol, or is it like, I don't know, some important part of the broader industry moving forward that the private sector would find a way towards in the long run anyways, and we're just nudging everyone along, right? I don't know. And fortunately, I don't think we need an answer to that question quite yet.
Yeah, I totally agree with that. I think there's obviously, like you said, we don't really need to worry about 5, 10, 15, out to 2050 what SAF demand looks like for Calumet to work in the near term over the next 2 to 3 years. I think there is that component to Calumet, which is like there is beauty and simplicity, and you have a highly levered company with a pretty favorable loan coming in that's going to recapitalize or take out the higher interest rate debt, so that they can then affect the change that they want to make, and implement parts of their plan. And so there's like the macro side of sustainable aviation fuel and renewable diesel, which is obviously like, if you want to get really nitty gritty into like the renewable diesel stuff, you have like Diamond Green Diesel, and you can look at like the Valero, indicators and whatnot. But I do think there's a simplicity to Calumet, which is you have a levered balance sheet, you have a company that has assets that are monetizable, and you have 1.44 billion that's going to come in and replace the current interest rates and drop the interest rate servicing costs of to the tune of $79 million. Like that's how I look at it, mainly because if you start to get into the true nitty gritty of 3 to 5 years out, or even further, of like what is 1 cent of feedstock input due to the EBITDA of the company, it starts to get a little bit almost too large to comprehend. Whereas if you really think of it as like a balance sheet that you're just focusing on, and how do you make the balance sheet better, at that point you have the ability to truly potentially monetize MRL, or even, like you said, Dylan, the performance brand. So I think when you view it in that relatively simple framework, maybe too simple, but that's how I like to look at it, I think it is attractive, no matter how you cut it.
Yeah, it's kind of like it's an accretive deleveraging story in many respects, prior to even having to consider this, right? Because if this loan closes the way it's been advertised, and there was that third catalyst I mentioned earlier, which we'll probably get into, which is a stated intention for quite some time from the company to monetize MRL. As a shareholder of Calumet today, if this works out the way we think it will, there are buyers for these assets. The question becomes how much. But if they were to monetize MRL, the proceeds of that would entirely delever the balance sheet and more at the holdco. And so just through that process, quantitatively, there's a ton of upside on this equity because you are just buying a very levered equity, right? So it's kind of one way that I look at it where, you can sort of, as an intellectual exercise, think about where this industry is heading. But in terms of the actual investment thesis, I think there's strong enough evidence out there to support the fact that there are buyers of these assets right now, given all the mandates. And there have been some related transactions in the space where you can kind of like back into what a multiple might be, right? But if they monetize that, you get this loan, right? You get the loan, you expand, you monetize. This becomes a net cash holdco. And we haven't talked about the specialties business, like the legacy business, but it's a decent business, right? It's like good, not great, but like pretty okay business, right? So, to that end, I think if all these catalysts play out the way management has laid them out for us, and, I will say that they haven't made any promises they haven't kept here, right? Like they said they'd do the conversion, they said they'd get the loan. That's happened so far. So, if we just keep staying the path, there's a ton of upside just from really the math, right? Just from cleaning up the balance sheet, recapitalizing it. So that's, I think, at least the way I've orientated myself to the thesis, right? Like, obviously you need to consider this industry backdrop, but it's very murky. But the nearer term picture is just kind of a recap story.
Yeah, that's where I think the valuation gets interesting. I've seen some interesting like price targets by the end of this year, which seem pretty aggressive for some of them. Yeah. But I think there's decent chance we get some kind of catalyst news that starts to pop. But like when you look at the valuation, it's not that hard to pencil out like a pretty good jump from here. And like I don't want to like start throwing out some ridiculous targets, but like you start looking at like 30 plus. I think that's pretty reasonable given like how big of a game changer the loan is. So I don't know if you guys want to go into what you guys kind of expect as far as valuation and what you think is going to happen from here, but that I think would be interesting to chat about a little bit.
Karst, you want to take this one first?
Yeah, I mean, it's interesting. I mean, we were talking about this where, it's one of those things where I probably expected it to be at least in the high 20s by now. So I do think there's a component to this where, you really never know. But when I view MRL, management clearly views MRL's, enterprise value is large, value is larger than the entire enterprise value of the combined company. And so I think if you were to just say value MRL at $3 billion and, at the end of the day, it gets a little bit tricky because you do have to actually implement the plan that they have. And so I think when that first tranche of the loan hits and you start to decrease the interest, the servicing interest they have on their current debt by $79 million, like that's a pretty substantial amount of money for a company that's, does whatever it does in EBITDA. I think, the performance brands alone did like Specialty did like 42.6 million of EBITDA and MRL did 12.6 million of EBITDA in the last quarter. So $79 million that, you can kind of free up is pretty significant. So, I don't really have a price target in my head. I mean, I think when that first tranche hits, I would be surprised if we don't, at least get to the high 20s. But, and that's partially based off of where prices went after hours, right when that loan announcement hit, it was at like 26 or whatever not. And I think there is skepticism that people have about, the path forward, but I guess that's where, a lot of this is psychology, right? And I think that's where I've kind of anchored to once that first tranche comes in, is getting back into the high 20s and kind of seeing where it goes from there. But I don't know if you have a specific price target, Dylan, but I mean, I don't in particular. I just think higher from here.
No, I mean, I don't either. The common exercise that people do here, and I think it's theoretically the right approach, and then you kind of need to decide for yourself, what the EBITDA and what the multiples are. But the way I think it makes the most sense to do this is to find some kind of normalized run rate at Montana Renewables, put a multiple on that, back out the debt, back out the Warburg stake, 14%, right? There's your value, to Calumet. Then you have specialties business, which I think you can be a little more comfortable with that. 200 to 250 mil of EBITDA a year, maybe a normalized period. Whatever the multiple might be, maybe 8x for that, right? Back out the debt there, and then you kind of have a sum of the parts. And so I think really the key inputs and why you see, I've seen people say anything from like 35, 40 up to 80 plus on fair value. And what's doing a lot of the work there is how much EBITDA MRL can generate.
Yeah.
What the fair multiple is. And like, I don't think, given some of the things that we said leading up to this, that you can really get there with any certainty, right? So I think, the best way to do it is have like a range of ideas, right? Maybe, it could, based on, the nameplate capacity and some of the, at least Calumet's idea of what margin should be, generate like 600, 700, 800 mil of EBITDA and like kind of the max cases, right? In which case it's worth a ton. But like, we're so far away from that, right? So I'm just not really comfortable underwriting it like that. So, in my head, just as like a rough feel, I think it's worth 40 pretty easily, through just through like the deleveraging, and the interest expense saving from that, plus a wiping out of like the 2026 notes. And you do also have, I've kind of been lumping these together, but Performance Brands as its own monetizable segment, or monetizable business, which is like, correct me if I'm wrong, maybe like 30 mil of EBITDA, right? And a pretty decent business. So maybe you can get a few $100 million there, as well. So I don't know. I just, through a combination of those levers to pull, be surprised if you can't get to 40 here. And then the question from there becomes, what kind of EBITDA can MRL do, and what multiple can it be monetized at? Because I think that's, they've been pretty clear that that's the path ahead, right? There's going to be a monetization, whether it's an IPO or a partial sale, right? Like, we don't exactly know how it's going to unfold, but that is the game plan, right? So I think, the further upside from 40 comes down to, largely that question. But, my base case is about 40, which is double from here.
Yeah. I think that'd be a good way to transition to what you guys think on a potential IPO or spinoff or segment sale or whatever they kind of decide to do. Like, what do you think is maybe most likely there, and what would you guess the timeline looks like for a potential monetization?
So this is where I start to get a little bit, I think any type of certainty that's spoken about who buys it, how do they go about it, I think is, I think you're really kind of reading the tea leaves at that point. And I don't necessarily know what that monetization looks like. I know people have thrown around like as a natural buyer being Shell. And I think at the end of the day, a lot of the monetization of MRL is going to come down to how they publicly communicate any offtake agreements that they have, right? And what does that look like from a length perspective, and also from like a margin perspective. And so I think if you were to think about the natural buyer, I think Shell is probably a natural buyer. But I think if they were to IPO it, obviously they would be able to have some type of interest in the company still. So I get a little bit wary of talking about the M&A, or not M&A, but the monetization of MRL, because I do think it's a little bit, it would be down the road for sure. And I think you'd probably want to see some pretty good advancement on, delevering the balance sheet. But, that option is there for them. I almost view MRL as some type of, it's almost like an option to the parent, to Calumet. So That's kind of how I view it.
If you had to guess though on timeline, probably first half of 25, late 25, or even further out.
So I would say late 25 is my guess. I mean, I know like when I was thinking about the DOE loan, I think I think it takes longer typically these types of things than people want it to. So I would say late 25, early 2026. And I think a lot of that is going to be dependent upon the progress that they make on, deleveraging the balance sheet, and then also how they kind of start to view the Max SAF 150 project. They have that second reactor that they kind of have to start building up, and so that's how I view it. I mean, that second reactor kind of comes into play in 2026. So I would imagine that they'd probably want to provide more color on what that project looks like and how they're progressing towards that in 2025. And then from there, I think there's probably conversations that have already started, but probably progressed pretty deeply in the first half of 2025 and then, the latter half of 2025.
How about you, Dylan? You have any thoughts on what the path
Yeah,
forward looks like?
I don't really have much intelligence to add there, beyond I would echo the sentiment that things just tend to always take longer than you expect, right? And especially with this name, which never
Yeah.
reacts the way you think it's going to any information, right? Like, I just don't know. Maybe there's a world in which you get some kind of partial monetization, earlier that puts a mark on the asset at least. But yeah, I just don't know, and I tend to think that Karst's notion of this happening like a year down the road is probably the most likely. But yeah, I don't know. Like, maybe there's a buyer who's just sitting there right now saying, we can get this, for cheaper now before they prove themselves out. Let's just do it. But I'm skeptical that's the way it's going to unfold. Right.
Yeah.
One thing to kind of keep your eye on, right, is like just debt maturities, because, as this happens, that 80 mil of interest expense saving is huge. You don't really know where margins go in the interim, but, there's still a good chance that they're going to struggle to generate meaningful cash in the next couple of years. Right. And so if you have, I think, based on what's kind of happened, is you don't have any really material maturities now for a couple of years. But that's sort of one thing just to think about, is like, an outside date being like, at some point here, you need to get some cash on this balance sheet again. Who knows what happens? They could refi. There's tons of ways of doing this. And I do think like, this big influx of cash that will come from the DOE loan, and then other levers like performance brand monetization, like, really do de-risk the balance sheet. But yeah, I don't think you're going to be sitting here waiting years for them to get value for this, right? Like, so yeah, I would just kind of reiterate, I think sometime later next year is probably my base case, but could be later, could be before.
Yeah, interesting. The other thing that people have talked about that I think is part of the reason the stock's been all over the place over the last 3 to 4 months is some of the stuff with the options chain, some of the stuff with index inclusions, and that's more mechanical around the share price. But I'd be curious to hear if you have any thoughts on more institutions coming in and buying, because the institutional ownership's been pretty low. And if there's like, I think I saw in one of their presentations, like, hey, we think 6 million shares are going to get bought in December for the S&P 600 index. So, I mean, in theory, that could be interesting when you layer that on top of a expected close for the loan in December. But I'd be curious to hear if you guys have any thoughts on that.
Yeah, I had this, tweeted sometime, right before the C Corp conversion happened, saying something to the effect of, the stock trading down on this catalyst would be the most Calumet thing ever, right? And because I think everyone had in their
You were
mind,
right.
yeah, and I was right. I was being half joking, but turned out to be right, right? Like, they transition to a C Corp, the day it starts trading as one, the stock plummets, right? And so, obviously there's some people who have been maybe trapped in that structure for a while and wanted exit liquidity. But my point is I've been largely wrong on the way this is going to respond to technicals the entire time. which is a topic that is, in and of itself a little bit out of my wheelhouse. But there was a lot of speculation, upon the DOE conditional approval announcement, and the stock not reacting accordingly, that this was just like market makers and technicals with respect to options expiry, and that as soon as the options expired on that Friday in October, we'd wake up on Monday and the stock would fly. That didn't happen. Then I saw that exact same speculation for November's OPEX also didn't happen, right? So I don't know how much like that's playing a role. It may be. But with respect to, like forced buying from indices, like, they do lay it out in their slides. And, if you take what they're saying as meaningful, I think it's like 11 million shares of demand from inclusion, in the next 6 months or 7 months, right? I don't know how that ends up working out, but it's certainly not a bad thing, right? Like, there may be like short-term distortions, but notwithstanding the C Corp conversion not really acting as an immediate catalyst, the average daily volume has improved materially, and it's a lot better than it was when it was an MLP. Right? Like this thing, it had like a micro cap OTC kind of chart some days before the conversion, right? You just see like straight jagged lines on the chart. So we have improved, and I do think that incremental buying could be huge. And the float is smaller than the shares out, right? Like you do have a major shareholder involved here, so I think it's an interesting ancillary dynamic, but it's not really something I'm focusing on too much because A, I've been wrong about it, and B, I probably don't know enough about it.
Yeah, it'd be interesting to see if institutions start coming in like by the end of the year, or if they start to take a closer look if there's less uncertainty. But I don't know if you have any thoughts there, Karst, on institutions or the index or the options chain or any of the above, but be curious to hear your thoughts there.
I don't really have many thoughts on the options chain or like the passive buying. I just think that, when you think about what happened with the C Corp conversion, it was an extremely favorable event to current shareholders, but also to future shareholders. So when you look at that C Corp conversion, I think, Calumet gave, 5.5 million shares and 2 million warrants to the GP, right? And that strike for the warrants is $20, and it expires in 2027. And I think, it was 4.5% dilution. So it was like 82 million shares, before, and 85.9 after. And when you kind of think about the effect the warrants have, like when I view, the options chain and passive, there's so many things that can happen. I think Dylan put it well. Like there's things that can be obfuscated and whatnot, and that's tougher for me to kind of gauge. But when I think about the actual core, structure of the equity, and like what is, this C Corp conversion do, instantly when it happened in July, but also out, to 2027 where those warrants are. I mean, you're looking at like a maximum of 1.3% dilution on top of that 4.5% that it initially happened. So I think, there's not all of a sudden a massive amount of shares, that, mutes the impact of like the gain in the equity. I think the stock options and the passive buying, I think when they became a C Corp, all of a sudden that starts to matter a lot more because it didn't matter previously. So to say that it doesn't matter, I think would be wrong, but to also say that I have some insight into how it impacts the stock, I mean, I wouldn't know. I just think, prior to that C Corp conversion, Calumet was a busted MLP. They hadn't paid a distribution since, 2016. And there's really no buyer for that, right? Who wants to buy an MLP that, other than me, I guess, that doesn't pay a distribution, right? So I think now that you have institutions that can purchase, you have not just retail investors and MLP firms. I mean, I don't even know if MLP buy side firms were buying, Calumet. I mean, it was a busted MLP. So I think now that you have these, these inclusions for passive investments, and you have, institutional investors that, will have an increase, I think there's the possibility that starts to impact the stock more. But I really do, at the end of the day, think that it's a balance sheet event. first and foremost, and then everything else is, not secondary, but tangential to that story.
Yeah, I think like you guys have kind of said, I think the biggest thing is like once the uncertainty around the loan goes away, it I think it starts to get pretty interesting just because you don't have to wonder, is this gonna show up? Is Trump gonna, or whoever he appoints, gonna come in and smash this thing? Like there's a lot of moving pieces, I guess is a short way to say it. So is there any other topics you think that we kind of gloss over or anything else we should kind of hit on Calumet?
I mean, I would mention that, at the end of the day, you do also have a core business that they have to service, right? At MRL currently within renewable diesel. And so I think part of the problem maybe that people have seen with, the valuation of the equity is, the margins, the diamond green diesel indicator has just been, destroyed this year. If you look at like the Valero indicators that they publish pretty frequently, I think it's weekly. You've gone from in March of 2024 at like $1.33 per gallon to, in August it was 73 cents. So that's a pretty substantial decrease. And so as you kind of start to see stabilization or an increase in that margin, I think there is a core business that they have within MRL for renewable diesel that starts to be more impactful, and maybe people start to view it and wake up to the actual value of MRL and that core business that they have with RD. But that would be my other point is they have a business at the end of the day that they have to service. So as much as this is a balance sheet thing going forward, I think maybe there's that kind of overhang being they have to prove up what they currently do and whatnot.
Yeah. How about you, Dylan? Anything you want to add before we get to the closing question?
Not much. I would just say, we didn't spend a lot of time on this because obviously not that important to at least the event part of the thesis, right? But, just the, Calumet specialties and performance brands business, it's, it's worth, thinking about. It's not the worst business, actually pretty good business. It's more stable than your normal refining assets. And like you have, crucially, I think, levers to pull there as well. Particularly, I've said this a few times throughout this hour, but like performance brands as something that could be separated and monetized, just adds another lever that they have here to get value, right? So this, we've been really focused on MRL, but there are really, three kind of separate components that form the sum of the parts here. And, so it's just worth thinking a little bit about those other two. I don't have really much interesting to say, but, you could get, I think, pretty, I don't think it's ambitious to say you could get a few $100 million for performance brands, right? Which, in and of itself could go a long way, to creating value to the equity just through a deleveraging, right? So, it's, there's a ton of different ways this can pan out. But, when you kind of zoom out, there's so much value in these different segments. And, so you can, you can win in multiple different ways here, right? And hopefully these are not, one or the other, but a cumulative unfolding, right? Like you just get value for all of this.
Yeah.
So the best case possible, I think, is, maybe you sell performance brands, and then maybe a year down the road, you monetize MRL for some really big, amount of money, and then you basically just have, Calumet specialties with a clean balance sheet, doing 250 million of EBITDA or something, right? Like it's like if that's the way this unfolds, shareholders are gonna be extremely happy. But there's a lot, between here and there that could happen. That could also be, could also generate a pretty significant return.
Yeah, interesting. So I think with that, we'll shift to my closing question I ask every guest that comes on. So I guess I'll be getting two in today. But the closing question is, what book should I add to my reading list? Can be history, finance, anything you guys think would be interesting.
Oh, that's a good question. I read recently, and this is become somewhat of a popular book, but How the World Really Works, I think it's called. It's actually somewhat relevant to what we just went through, right? But basically, the book is about the importance of energy in our world, particularly fossil fuels, and how it's kind of powered and enabled everything in civilization over the last couple hundred years. And it says a lot of things that I think most people kind of know intuitively, but it's interesting to see it like quantified and put through examples. So, easy read, but I'd recommend that.
How about you, Karst?
I just finished Throne of Grace, which is about the early expansion in the American West by Jedediah Smith of Jedediah Smith, and it's written by the same guys who wrote Last Stand of Fox Company, Bob Drury and Tom Clavin, and so it's kind of I'm a big fan of reading books about previous adventures, whether it's Lost City of Z, Endurance. Through the Brazilian Wilderness by Teddy Roosevelt. But I think Throne of Grace is a good one. It's a really kind of crazy story, and it puts into perspective, what those early pioneers in America kind of went through to just, get to Washington, Oregon, California, and then down to the Southwest. It's a pretty amazing story. And so not finance related, but that's what I'd recommend.
Yeah, I'll have to check both those out and add them to the list. But I guess one last thing before I let you guys both go, where can anyone listening find you guys, whether it's social media or on Substack?
Yeah, Substack's Raging Bull Investments, and you can find that through my Twitter, which is just Raging Bull Cap is the handle.
I'm on Substack, karstresearch.substack.com, and then you can also find my Twitter account, X, whatever you call it, at Karst Research, and my Substack's in my bio. Yeah.
Awesome. I think it'll always be Twitter, no matter what Elon tries to rename it. But
Same.
anyway, I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.